In this example, we're going to look at the T account transactions for the purchase of merchandise using the periodic inventory system. So remember, with the periodic inventory system, we are dealing with a system that does not update its inventory and cost of goods sold after each sales transaction. The cost of goods sold is not updated and the inventory is not updated until the end of the accounting period, and that is done so on the periodic income statement. So be sure and watch the examples on the periodic income statement. So August 2nd says that we purchased merchandise on credit from Vera Company, invoice dated August 1st, terms N10, FOB shipping point for $1,150. So August 2nd is the day that we will record our journal entry. Terms N10 means that the net amount is due in 10 days. We have 10 days to pay our bill. And FOB shipping point says that the buyer is responsible for shipping cost, because the shipping point is the point at where the ownership of the merchandise changes hands, and whoever owns the merchandise bears the shipping cost. So if as soon as it's shipped the ownership changes hands, that means the buyer owns the merchandise and therefore will pay for the shipping costs. So we're going to record the purchase of $1,150. So on August 2nd, we're going to use our purchases account. Also in the periodic method, we do not use the merchandise inventory account. We use an account called purchases. So on August 2nd, we will record $1,150. And it's the purchases account that will show up on the income statement that helps us calculate our new inventory and our cost of goods sold. So we debit purchases on August 2nd for $1,150. And since we bought it on account, we will credit accounts payable for $1,150 on August 2nd. Then on August 3rd, we received a bill from Strauss Shipping Company for transportation costs on August 2nd shipment, invoice dated August 1st, terms N30 for $105. So that's our bill that we have to pay for shipping, and we have 30 days to pay that bill. So we're going to record the shipping cost, which is freight in, on August 3rd for the amount of $105 that we pay for shipping. Now we're not paying it right away. We received the bill, so we will also credit our accounts payable on August 3rd for the $105. Then on August 7th, we returned damaged merchandise that was received from Vera Company on August 2nd for credit of $180. So we're going to record the return as of August 7th. So when we record the return, we no longer have to pay for that, so we get to debit or decrease our accounts payable account for $180. Now we do not do anything directly to our purchases account, but we will use our contra purchases account, purchases, returns, and allowances, and record the $180 there. Then on August 10th, it said we paid in full the amount due to Vera Company for the purchase of August 2nd, part of which was returned on the 7th. So we have to determine how much do we owe. Well, we originally purchased $1,150, but we returned $180, so we only owe $970. So we will debit our accounts payable on August 10th in the amount of $970, and then we're paying with cash. So on August 10th, we will credit cash also for $970. Then we will go through and foot and balance our accounts. So for accounts payable, our footing is $1,150 on the debit side, and the credit side has a footing of $1,255. So when I find the difference and put the difference on the larger side, I have a difference of $105, and that represents our freight in that has not yet been paid. It's still sitting in our accounts payable. Our balance in freight in is $105. Balance of our purchases is $1,150, and the balance of our returns and allowances is $180.